Good afternoon, ladies and gentlemen, and welcome to the Vodafone investor presentation. Throughout today's recorded meeting, attendees will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today, and we'll publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. I'd now like to hand over to CFO Luka Mudric. Good afternoon.
Thanks a lot, Mark, and thanks for having me. Yeah, indeed, it's been 6 months since I've last appeared on this platform to give you an update of the company and its transformation. Back then, we covered 4 key themes. One was that we were leaning into a broad-based transformation of our market portfolio with our back then announced sales of our businesses in Spain and in Italy, and the merger in the UK with up to obviously markets where we have good local scale and where we enjoy a good market structure. We talked about the operational excellence push across the company, focusing on 3 strategic priorities, improving our customer experience, simplifying our operations, and setting ourselves up for growth in new areas of priority, like our B2B business, for example. I covered as well that in this journey, our current fiscal year, FY25, would be a year of transition where we would face significant headwinds in our largest market in Germany from an ongoing transition of the legal framework around our TV business, and that would bring headline growth down in service revenues, but that at the same time we saw good prospects of increasing our profitability across the company, and we also guided for positive growth in cash flows. And I was clear that once we are through this year of transition and from our next fiscal year, FY26 onwards, the full benefit of our market portfolio and operational excellence transformation would come to bear, and that we would see accelerated growth again as a result of that. Now, halfway through FY25, I'm pleased to say that we have made good progress across all of those pillars. Our strategic portfolio transactions in Spain have already closed. In Italy and in the UK, we are nearing completion and will likely be in a position to close those early next calendar year. In terms of our operational excellence priorities, we're also making good progress, and it shows actually in terms of good performance with market share gains across most of our markets in Europe, and a continued very strong performance in our emerging markets. And in the current fiscal year, the financial performance exactly reflects what we had anticipated, with us continuing to reiterate our guidance at the half-year mark. So let's take all of those aspects in turn a bit and go into details. In terms of the financials, what you can see on the slide on the left upper hand side is indeed that due to the fact that in Germany, where we are the largest cable TV provider and have had 8.5 million of customers in multi-unit apartment houses that are operated by housing associations, where a law change has required us to recontract with those customers individually, where previously they were subject to bulk contracting through the housing associations. We have a significant headwind from a service revenue perspective, and that has brought headline growth down, together with the fact that we are having a lower inflation environment, and therefore also CPI index linked price increases have come in significantly lower in FY25 compared to the prior year. You see here the growth coming down to 4.2% in Q2 and 4.8% for the first half year. That was perfectly in line with our expectations. We expect a gradual re-acceleration now at the group level from the second half year on. And within that, our B2B business, that is one of our growth drivers, has actually already started a re-acceleration, and we expect it to further accelerate in the second half year. You can see then in the lower left-hand corner that, of course, this growth is unevenly distributed. We continue to enjoy very high growth rates across our emerging markets, with Africa continuing to grow just below the 10% mark in service revenues. Turkey having a very strong performance, almost 50% growth in hard currency in euros. And then in Europe, where we are facing the full headwind of the German TV transition, we are actually down to slightly negative service revenue growth. The flip side of the lower inflation environment, in a positive sense, then shows, as I had already indicated half a year ago, in terms of the profit performance of the company. Our adjusted EBITDA was up 3.8% in the first half year. That's in terms of growth, quite a decent step up from what we had seen last year in H1, still under the old portfolio, including Spain and Italy. We were just above 0% growth. Now the step up to 3.8%, I think, is a good precursor of the accelerating growth that we expect to be able to drive with the new set and more focused set of markets that we operate. And the same more focused market portfolio also shows in a step up of our returns. Our ROCE enjoyed a 1.4% step up from the disposal of Spain and Italy. With the rest of the markets, we are showing good progress, actually. You see a 0.4 percentage point performance step up in all of them combined, except for Germany, where the TV law transition had a sizable headwind. Also on the return side, 0.5 percentage points, but the trend definitely is going into the right direction. Let's from there then turn to our strategic priorities and how we are doing against them. As I said, customer experience improvement, simplification through removing redundant roles across the company, commercializing our central shared operations so that it's easier for our markets to select which services they consider as valuable, and also potentially gain external customers, and then the growth opportunities that we have in particular in our B2B business. If we translate them into specific focus areas for the current fiscal year, then we are making a big push to invest in the continued turnaround of our underlying German business, with a big focus on customer experience improvements, on establishing additional digital capabilities, AI capabilities, for example, in our chatbots, supporting our customers on the ground, but also continued step up of investments in our B2B business and other areas. B2B in general is seeing a big investment plan, 250 million in additional feet on the street, additional demand generation and expansion of our product portfolio. And then, of course, we want to complete our portfolio transactions and continue to gain value from our set of non-consolidated investments that are now managed by a dedicated unit called VODAFONE Investments. In terms of the strategic priorities, though, if we want to take a double click, I'm pleased to say that we continue to see progress through all of our focus on managing a better customer experience, on the reduction of deep detractors across our customer portfolio. This is actually pervasive and is happening across all of our markets. The resulting revenue market shares are also up in many markets, in the UK, in our other European markets, in Turkey, by the way, as well. In Africa, market shares are broadly stable, but in Africa we are leading the market by a wide margin. So the only market where we still need to complete the turnaround and transformation, as said before, is Germany, where we have this idiosyncratic impact of the TV law change that is hitting us in an over-proportional manner because we are by far the biggest TV provider in the market. Having said that, also in Germany, but in general, we keep making good strides in terms terms of improving and optimizing our network quality as, of course, one key pillar of driving customer satisfaction and our competitive position in the markets. In Germany, we have actually just won the reward as Germany's best broadband offering by 4 independent network tests. So our investments into the stability of our cable network have clearly paid off in this respect. And also across our mobile networks, we continue to meet very high quality standards. Actually, in Germany, again, have inched a bit closer to the market leading incumbent and have distanced ourselves a bit further from the third player in the market. So this is going into a real good direction. In terms of simplicity, we have already taken out 6,300 roles across the company in our push towards simplifying our structures, operations, delayering the organization. And there is another close to 2,000 pending that we have already announced in Germany, which will take us by the end of the year to more than 8,000. So this is on a good path. We continue to focus on driving gross savings in operational expenditures, but we have taken the conscious decision, as discussed previously, to invest these savings in the current fiscal year in an accelerated improvement of our commercial performance in Germany. So brand and share of voice investments in Germany are intensified. Our B2B investments in Germany are continuing to progress, and we continue to focus as well on investments to improve the customer experience there. Next year, we expect that our significant programs that we have going on in the area of AI across the company, coupled with continued focus on productivity, will then actually make room for further OPEX savings. And in terms of growth, you can see here on the right side of the slide that actually the change of the portfolio and the focus on our strategic priorities is resulting in a step up of growth versus what we reported in the old market portfolio in the first half year. So service revenue growth up by 60 basis points, EBITDA up by 3.5% over the growth that we've shown in the first half year of the last fiscal year. And also our adjusted free cash flow, which in the first half is always a negative number due to working capital unwinds from the previous year, is in a much better place than it used to be the year before. So all of this is actually quite encouraging, but of course we also have jobs to be completed still, and now we are nearing very significant events for the group because our merger in the UK with Free is now nearing completion with the final CMA ruling, so antitrust ruling for the merger being due by the 7th of December, perhaps a day prior or so, because the 7th is on a weekend. And the good thing about it is that the CMA does not seem to see a need for structural remedies, is rather proposing and discussing with us a set of behavior remedies that are well in line with what we had said all along from the outset of announcing the transaction we would be willing to do, such as committing to invest significant amounts in network expansion, such as keeping prices for certain lower value tariffs stable or for a period of time, and also making a commitment for a reference offer to MVNOs in the market so that they continue to have an attractive route to utilizing the joint network of Vodafone and Free as an alternative to BTE and VMO2. If the CMA ruling comes in as we expect positively, we should be in a position to close the transaction in early 2025 and then give to all of you and the rest of the market a clean guidance for the next fiscal year, including the combined UK entity. The same can be said about our sale of our Italian business to Swisscom. which would be an 8 billion transaction for us, so very important from a deleveraging perspective. Also here, the Italian Competition Authority is nearing completion of its review and will come up with a final decision by mid-December. And that means if everything goes well, which we fully expect it will, that also the Italian sale will complete in early 2025, which would then allow us, subsequent to the receipt of the cash inflows, to also initiate in due course our next 2 billion share buyback program that we had already committed to when we signed the Italian transaction. In terms of Spain, as you know, we have already received 4.1 billion of initial cash proceeds. We still have value locked up in 0.9 billion of redeemable preference shares, which might be, giving us additional inflows if our acquisition partner Zegona can actually complete value-adding transactions in the Spanish market and then utilize the proceeds in order to redeem the preference shares. That does not mean that we don't focus on small transactions to further improve our performance in other markets. For example, we've just recently announced that we are in discussions with Digi and Deutsche Telekom's subsidiary in Romania about potentially consolidating the market further with acquiring the mobile assets from Deutsche Telekom. This would be a very small transaction, but important in the Romanian market context, as it would give us better scale and an ability to also drive for better returns to reach our cost of capital in that country. And the share buyback program, as a result of the sales transactions, is well underway. We have already returned more than 1 billion to shareholders so far, and we are well underway of completing the first 2 billion in this fiscal year, with then the next leg starting when Italy is completed in the new fiscal year. With all of that, of course, we also want to make sure that we stay true to our capital allocation framework that we committed to shareholders in March this year. And so far, we are perfectly on the path of doing that, with our country level capital intensity broadly maintained at the level where it was last year, with coming into our target leverage range. We had set a leverage policy of 2.25 to 2.75 times net debt to EBITDA. So a step down actually in net debt levels from the previous levels. And now with the Italian transaction completing, we expect to reach the bottom half of that range, perhaps even temporarily slightly below that until we launch our second leg of our share buyback program. The dividend had to be rebased, as you will recall, to 4.5 cents because we are losing quite some cash flow through the sale of Spain and Italy, and commensurate with that, we have now the new dividend, but this dividend is well underpinned by our cash flow. So we clearly have the ambition, as the cash flow is expected to grow over the next coming years, then to grow the dividend as well over time. And from a capital returns perspective, after the 4 billion of share buybacks, we would still have some flexibility left, because out of the 8 billion of the two transactions for Spain and Italy, we actually need 6 billion for the deleveraging into our target range. We do the 4 billion of share buyback. So there are 2 billion left that could provide some room for further capital returns or value accretive transactions, or could be employed for further deleveraging. So with that, I would say we are exactly where we wanted to be at the half-year mark. We are looking forward to closing this year in line with our financial commitments and our guidance, and then look forward to entering FY26, a year where then the full scale and scope of the transformation should yield the positive outcomes in accelerating growth that Margherita has talked about in her quote for our half-year earnings as well. And with that, I will be happy to take your questions.
That's great, Luca. Thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated on the right-hand corner of the screen, and then I will pose those questions to Luca this afternoon. Luca, we've received an awful lot of questions throughout your presentations. Perhaps I could throw two to you at the same time, really regarding your progress and its relation and correlation to the share price. The first one is, you and Margherita are doing an excellent job. What do you think the market is failing to understand or understanding about your transformation, and hence not rewarding the progress made so far? And the other question is the predicted growth and the other question was, is the predicted growth in revenue and EBITDA reflected in the share price, or are analysts still too cautious?
Yeah, look, those are good questions, and obviously sometimes it can also be frustrating a bit for us. However, I think we need to recognize that in a market environment in which you obviously have a lot of volatility, the typical theme of shareholders and investors is, in particular in an industry like telco, which has seen quite a declining trend over quite some time, that only seeing is believing. And while we have made great progress on the portfolio front, and we see that the fundamentals in terms of our market position in many of our markets is quite good. The one thing that shareholders have still not seen is obviously the completed transformation in Germany, which is by far our largest market, and the return of Germany to growth. For now, at the headline level, they are seeing the service revenue performance in Germany deteriorate. It's a U-shaped form of recovery that we have been talking about a lot, and that was mechanically unavoidable given this law change in our TV business, which had a significant negative headwind effect. And so I think investors just want to see that as we are coming out of that trough, we can indeed produce accelerating growth, and then I'm pretty sure that they will actually also join the bandwagon. And I've seen that movie already also in the past. We are, at the end of the day, in a subscription business, and therefore our commercial performance today only shows over time in the numbers. That was the same with my prior employer in the software industry. And then 2 years later, when all of your commercial efforts finally show in the revenues, then investors might regret not having joined earlier. But again, we need to prove the case, and I think it's just the same story for your second question on the revenue and EBITDA performance. Even though I should say that the market should actually take a lot of comfort from the fact that we are growing EBITDA, despite the fact that in Germany we are facing a 400 million headwind in EBITDA due to the TV law issue. Actually, on cash flow, where we are also guiding for growth and are delivering an improvement year over year, as you have seen, it's even 500 million because there's an additional working capital adverse effect from the MDU transition. So I sense that investors should actually gain confidence from this performance, and then just in their mind frame a scenario in which this TV law transition is out of the prior year comparative figures, and then making room for the improvement in the performance in Germany. And it's actually almost mechanical that this needs to give rise to a much better growth performance in FY26. I think as we move closer to the end of the year, this should start to shine through.
That's great, thank you. Got a question here from David, I guess, around capital allocation. What factors would need to align for Vodafone to consider increasing the dividend again?
Yeah. Again, for me, the dividend is really mainly a factor of how well we are able to produce sustainable cash flows that underpin the dividend. I am not a believer at all that you should actually tap into the substance of your business in order to pay a dividend. If you do that for too long, then you're actually weakening your business fundamentals. So for me, the true measure of our ability to increase the dividend is how well we are doing on the true free cash flow of the company. Below the adjusted free cash flow that we report and that we use as a guidance basis, we also have the ongoing costs for spectrum licenses and for restructuring. Luckily, those two elements rather tend to come down now as the years of significant spectrum auctions, at least in Europe, are pretty much behind us. That gap between our adjusted free cash flow and the true underlying free cash flow should actually diminish over time. But this free cash flow needs to underpin the dividend. And as we then increase the free cash flow through our focus on operational excellence and the fact that we are operating in markets where we can actually accelerate profitability increases due to the soundness of the market structure and the strength of our assets, then we should also have scope to see increases in the dividend. In the meantime, I think it's worth noting that this year and next, we will actually return roughly 25% more capital to shareholders than we did under the previous dividend policy, because the value of the share buybacks of 2 billion roughly per year actually significantly outweighs the reduction of the dividend. So from that perspective, it's something to be kept in mind. And of course, the more we reduce shares through the buybacks, the more also the earnings per share increase, which is also a countering effect.
Thanks, Luca. Next question, I guess, around price increases and your ability to retain customers. It reads as follows: how has customer churn been impacted by price increases, or any steps being taken to ensure customer retention?
Yeah, very good and very important question. For me, churn is one of the most important operational KPIs that I'm taking regularly a look at, because the value of retained customers to drive also long-term customer lifetime value and returns cannot be overestimated. Luckily, I have to say that churn in a number of our markets is on a good path. So it's correlated with customer satisfaction. It's correlated with NPS and our deep detractors. And of course, every time that you enact a price increase, then you will see a short-term spike in churn. But in general, even in markets where we have had a long history of CPI-driven price increases, like in the UK, for example, the trend is actually very positive if you focus at the same time at the right customer experience and solving customer problems with agility, focusing on the quality of your networks. Those are all things that play also a significant role. It's not only the prices that you offer. And in the UK, actually, we have just reached a record low level of churn in the market, a level that we had never seen. And it's all coming on the back of many years of focusing on providing the best customer experience in the market. And we are employing this same playbook, as I had said before, now across our markets. And in many of them, actually seeing a positive trend. The one market where this is not the case, again, is Germany. But in Germany, there is a combination of factors at play. In our TV business, a lot of customers who were indirectly paying for their cable TV through their housing associations, now that we have to recontract them directly, we find out that they have actually not been using basic TV at all. And in those cases, of course, you will then inevitably face a higher churn when your contracting model changes. And then last year, we had done for the first time in quite a long time a price increase in our fixed broadband business, and that has led to elevated churn. But this churn is now also coming down and is stabilizing. So we are expecting continued improvements in our broadband net adds as a result of that. And therefore, as we move into next year, should also see definitely churn improvement in Germany. So that's a very, very important question to ask, and one of our biggest priorities as a company.
Thanks, Luca. Just, I guess, extending that around how things are progressing with 5G, particularly in Europe and the UK. Are there any timelines or perhaps milestones we should be aware of?
Yeah, honestly speaking, 5G is obviously a very heterogeneous technology in terms of its adoption and proliferation across the European country landscape. Germany, for example, is quite advanced in the rollout of 5G standalone. We have, by all the three main players in the market, Deutsche Telekom, Vodafone, and Telefonica, significant population coverage. Well in the 90s, we have actually deployed 5G high-band sites at the same level as Deutsche Telekom in the country. And so in Germany, 5G is essentially rolled out. There are some additional coverage obligations that are likely to be in place when the German regulator is extending the spectrum licenses for another 5 years, which is a move that is expected to come in spring 2025. But the step up is not as big as it is, for example, in the UK, where we are really lagging behind in terms of 5G adoption. And that's why the merger of Vodafone and Free is so essential, as it will give us finally the scope and the investment capacity to really drive a broad-based adoption of 5G on a nationwide basis, where for now, Vodafone has really been more focused on driving this rollout in the large urban centers. So it's a very, very important consideration as well in terms of value for the country for the merger between Vodafone and Free, that this will allow us to accelerate the deployment of 5G. And then other countries in Europe are at different stages, but I'm really almost a bit embarrassed to say that the UK is really one that needs to now speed up urgently, and we want to be part of that solution. Outside of Europe, 5G is not yet arrived. So in Egypt, we just closed a 5G license arrangement with the Egyptian state, as all of the other operators in the country did as well. So there, the 5G rollout will begin next year in FY25, in calendar year 25. And in Turkey, we're expecting a similar 5G license transaction coming up, driven by the Turkish government sometime in the next 2 years as well. And subsequent to that, we would also then see the rollout starting in Turkey. So it will take a while depending on the country, but I hope that the UK will get a little bit more onto the front foot soon with the success of the merger.
Thanks, Luca. We did have a follow-on question. Actually, I know we touched on client retention a few moments ago, but how is the rollout of AI-driven digital assistants impacting customer engagement and operational efficiency?
Yeah, great question, and a big focus area for us. I mean, you may have heard that we have been closing strategic partnerships with the two arguably most advanced AI tech companies that you can think of, Microsoft and Google. And we are working with them in different areas. Google more around the network, and with Microsoft more in the area of customer service. And I have to say the results are very promising. Give you one example. We have started the rollout of a Gen AI enabled, much improved version of our famous chatbot Toby, called Super Toby. in a number of markets now. We started this in Portugal and Turkey, in Italy, and now we're rolling out in Germany as well. It's actually quite amazing to see that with the Gen AI enabled version, we achieve improvements in the first call resolution rate of up to 50% and a significant step up in high double digits in terms of NPS improvements. So this is really very promising. And if you have an improvement of 50% in first call resolution rates on a chatbot that is used, 40, 50 million times a month, that's actually providing significant productivity benefits, but of course also experience improvements if you get your problem resolved automatically and don't have to be transferred to a call center. In the call centers, by the way, we also have great use cases for Gen AI, also in conjunction with Microsoft. We have an assistant, a digital assistant called Super Agent that is available to all of our call center agents and can be utilized by them in order to get suggested solutions for customer problems as they are going through the calls with them. And it's actually quite helpful in order to bring up the quality of our call center agents to a similar level much more quickly, especially also for the newcomers. And this is important because you have typically a lot of attrition in those call centers. And so the super agent is extremely helpful in that respect. So I would say AI in our industry and AI at Vodafone will give us scope for productivity improvements and cost savings, definitely in the next 2 to 3 years. But perhaps even more importantly, will allow us to have a significant contribution to customer experience. And that's where the jury perhaps is still out there. I even see scope for it to become a revenue contributor because as the demand will increase for AI interactions of consumers with large language models in data centers, I think so will potentially the demand for low latency, high performance connectivity access to those Gen AI capabilities. And that could give rise to interesting new monetization opportunities for telcos.
That's great. Thank you very much indeed. Let's turn, I guess, to a different topic here around staff changes, I guess. There's been a lot of management churn recently, e.g. the ExCo in Germany. Why are you making all these changes?
Well, first of all, I think in Germany, the refurbishment and I would say step up of the management team is one of the critical enablers to our commercial success. We wanted to make sure that we have a setup where we can cross-fertilize best practices and insights from our other markets where we have been driving successful transformations that go into the same direction as what we want to achieve in Germany as well. And then within Germany, wanted to make sure that we bring really seasoned industry veterans with a lot of experience into the company in order to drive the commercial and the underlying process transformation towards excellence in the market. And therefore, it is very helpful that we have now a simplified ExCo structure. If I now also at the group ExCo, where Ahmed Essam, our former CEO for the UK, is now responsible as CEO for all of our European markets, and therefore has now the opportunity to work very, very closely with the German management team and bring in some of his commercial experience and the best practices from other markets so that we can bring them to bear in Germany as well. So there's a much closer collaboration now between Germany and the German management team and the group level in this respect than perhaps what we had in place a couple of years ago. In Germany itself, We have just onboarded a new head of our B2B enterprise business, Hagen Rickmann, joining us from Deutsche Telekom, where he was responsible for the German B2B P&L of Deutsche Telekom, which is a massive business, obviously, as you can imagine. And we are now onboarding a new head of our consumer business, who's joining us from Telekom Austria, also a very experienced guy, having a lot of transformation experience in B2C. And then very importantly as well, we are bringing in, or have just brought in a new CIO, so head of digital and IT for Germany, as the agile transformation of our customer experience relevant systems is a critical enabler for success in the market as well. And that will be Fernando's priority. So in this respect, we have now all of the key critical positions in the German management team filled with people who have been living and breathing telco for their entire professional life, who have lots of transformation experience as well. And that's what you need, together with Marcel de Roth, who was our CBU, so consumer business director previously, and had a very seamless step up to the position of the CEO at the beginning of this fiscal year. And he obviously comes with a lot of success as well in his prior role, for example, by setting up the sales machine that has allowed us to go through the TV law transformation, recontracting 4 million customers in just a few months, exactly in line with our planning. So I think we have now the right team on the ground that will see through the success of the transformation. I'm very happy with this structure, but also with the simplified management team at the group ExCo level, because we have now our African and European markets represented through 2 CEOs, where we previously had 5 CEOs of different markets at our ExCo level. So this allows us also to streamline and simplify our alignments at the group ExCo level and come to simpler conclusions. So in all of this, simplification is also an important consideration.
Thank you, Luca. Question here around the CMA approvals. Why should the CMA approve the 3 UK merger, in your opinion?
Well, because it's good for the country, because it's good for customers, and because it's good for competition. That's what we always said, which is quite unusual statement to make for a merger in the telco industry. I get that, but in this case, it's truly the case. Why is it good for the country? We have discussed this a bit. As of today, neither Three nor Vodafone have enough scale to invest decisively in the nationwide 5G rollout. Together we can, and we are ready to commit for an 11 billion investment commitment to roll out 5G across the country. This will be great for coverage across the country and for access of consumers to really robust connectivity anywhere in the country. It will be good for competition, because we are not really consolidating 4 players to 3. As we are saying all the time, we are actually expanding the market, in particular for MVNOs. So for the Lycas and Lebaras, the Skies of this world, to choose from network operators on which they want to roam and then position their services to customers, from 2 to 3. Because with the combination, we will be a very valid alternative for them. Today, close to 90% of the MVNOs in the UK market are actually on BTE or VMO2 networks, and they are the ones that are really driving the competitiveness in the market by setting their price points in an attractive fashion. So if they have more choice, they can do so also in an even broader fashion. So it's very good for competition. And for the customers, obviously, it's also good because we have given the commitment that we ourselves will keep serving certain of our tariffs stable for 3 years post the merger, while those customers will benefit from greater quality through the higher investments that we will be able to make. So at the end of the day, it's a win-win-win for everyone, and I think that is exactly what the CMA has recognized as well. And that's why they have considered structural remedies as not appropriate in this case. That's why they have essentially said, okay, if you stay true to your words, if you're ready to commit to us what you have officially told all of the market participants when you were announcing the deal, which we are ready to do, then this is a reasonable way and path forward. I'm simplifying now, but this is exactly what we're working towards. And the CMA, I think, in its decision can be, in this sense, also a blueprint for other European places to follow, either at the national level or at the EU Commission level, as I think it's a very constructive way at looking at the value of market consolidation for an entire economy.
Luca, thank you very much indeed. And thank you to everybody for your engagement this afternoon and for all your questions. Luca, I know feedback is particularly important to you and to the rest of the board, and I'll shortly redirect those on the call to give you their thoughts and their expectations. But before doing so, I wonder if I may, Luca, just ask you for a couple of closing comments, and then I'll send investors to give you their feedback.
Yeah, thanks a lot. I'm happy to do that. First of all, thanks so much for your interest in Vodafone, a company in transformation, as we have discussed now twice. I want to leave you just with a simple thought here. I think we are nearing the completion of the heavy lifting of our transformation. We are looking forward to closing FY25 in line with our financial commitments. From FY26 onwards, we really want to drive for accelerated growth across our business. Most of our markets are doing very well already. Next year, Germany will join the party and will return back to growth as well. And that inevitably will make for a very attractive backdrop. So I remain confident that we will emerge from this transformation as a stronger and nimbler company with better operating leverage and accelerating free cash flows, which then over time will also translate into better shareholder returns. And I would very much appreciate if you stay close to this journey and hopefully join us as well. Thank you so much for listening in and for the engagement. And I look forward to being back on this platform soon.
That's great, Luca. Thank you for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This may take a few moments to complete, but I'm sure it'll be greatly valued by the company. On behalf of the management team of Vodafone Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.